Welcome all back to Tech Tune Up with Paul Meeks. I'm your host, and we're brought to you by our friends at Benzinga. I follow their written and video content. You probably should too if you want to be a better investor. Today's June 4, 2024. Summer has started. We're now probably in between earnings reporting periods, right? The next data deluge will come in about the second to third week of the month of July, but still a couple things to talk about. Let's get to it. In this section, we talk about stocks in the news and how they're important, not just for their own sake, but even more broadly. So let's start with Apple. This is absolutely huge. Apple has a software developers conference starting next week. Obviously, we'll be reporting live on that, but it is really important for this company because right now this stock is trading at 195. Its all-time high is only a couple ticks higher at 199. Yet this company hasn't grown its sales for a year and a half to 2 years. So the reason I get into this setup is they better have a whopper of an AI announcement at their conference. I think what they'll probably do, if I were to forecast it, is do a deal with OpenAI, right? OpenAI is the bellwether in the space. The only interesting thing there is you also know that OpenAI is 49% owned by Microsoft. So they obviously have to have Microsoft say so. And in some aspects of their business, Apple and Microsoft compete. So I tell you, if we don't have a real needle moving AI announcement from Apple next week, I think that stock's going down. And I actually think, unless it's something really substantial, even if the stock pops on the news, right, a little bit of a relief rally, a little bit of view that the stock will participate in this AI infrastructure build. If that stock gets to over $200 a share, and I don't think that there's actually something substantive that came out of the software developers conference pertaining to AI, I might even short that stock. As you know from following my buy list, I haven't had Apple in my portfolio for quite a while. I've focused on other names in big tech, and they've done so much better. So it was a good call. Next, I continue to be confounded or at least chuckle about GameStop. Roaring Kitty is back, vaulting that stock up 70-80% in a single session. Remember, this isn't much of a business at all. Can you short it? If you short it, at least in the short term, you're going to get squeezed by Roaring Kitty and company. However, over the long term, on one of these announcements that Roaring Kitty is even looking at the stock, that it pops, if you have some gumption, if you can hold your short without getting squeezed, you will do very well shorting that stock over time. Next, this is interesting. You may recall my thesis, which is short everything to do with legacy media and go long in a pair trade Netflix, the greenfield media company that has no crappy legacy business to shake. It does look at long last that Paramount, which is the owner of CBS, is going to do some kind of merger association with Skydance, which is run by the son of Oracle's mega rich founder and CEO, Larry Ellison. But I will tell you this, two wrongs do not make a right. And yes, this stock might pop on the merger rumors, even the merger closing, but then it becomes a terminal short. I'd also short Warner Brothers Discovery. They're vying for a critical contract for the National Basketball Association. And if they can't pony up the over $2 billion it's going to take to secure those rights, they're screwed. There is no reason they'll continue to bleed subscribers. And then be careful what you ask for. If they can afford the $2 billion, they're so over-levered. They have such high interest expense that Warner Brothers Discovery might be screwed in the other direction for another reason. So next we have applied materials. Remember last time I introduced a basket of semiconductor capital equipment stocks that I thought would be reasonable plays. And let's go through the who's list. Globally speaking, you have ASM Lithography, which is a Netherlands-based company. You have Tokyo Electron, obvious Japanese. And then in the States, you have this Applied Materials, KLA Tencor, Lam Research, maybe Teradyne. But one of the things that surprised me, despite my bullishness that I detailed last week, the CFO of AMAT, who should know something about the company's finances, went into the market and sold 2/3 of his or her personal stake in the company. Why would they do that if they think that the stock is going to take off? Maybe it's a situation where you buy on the rumor and sell on the news. But anyway, that troubles me. Whenever you see very significant insider trading, in this case, it's a bad indicator because it's insider selling. In other cases, you see heavy insider buying. That's a tell to the good. So we'll see what happens. Next, we have Tesla. We talked about this last week, but they are still fighting very, very hard. Not just Elon Musk, even the board of directors, to approve his 2018 $48 billion compensation package, which is an absolutely nuts compensation package for somebody who already, through his share ownership, controls a big chunk of the company. This is one of the most egregious things I've ever seen. As you guys know, I'm no fan of Tesla. It's been a very good idea for me to not only recommend you short that stock, but at least if you're long, sell your position, be out of it, because there is an all-important robo-taxi announcement coming on August 8th. And if that doesn't change the world in some way, and I don't think it will, you're stuck with a declining electric vehicle business. And Tesla, if that's the case, can go way, way down. Next, we have Microsoft. Microsoft always has announcements, right? Microsoft is still on my buy list. But interestingly, they announced that they're going to build a data center in Malaysia. They are sprinkling the infield with data centers all over the Asian theater and trying very much so to diversify away from China, probably for the obvious reason. I also thought it was interesting that they are doing a deal with Hitachi, right? That's kind of a 70s conglomerate blast from the past, but a AI deal with Hitachi, probably in some sort of industrial applications. But let's see what happens. Let's see what happens. Everybody and their brother are announcing AI deals. And you guys know my belief is that AI infrastructure building is happening. It will continue. It's accelerating. It's real deal. We want to own those stocks. But I do not believe that most of these follow-on AI apps are going to be the real deal. And so I am not on any of the software companies focused on the AI space. I'm sticking with the infrastructure builders. So far, I've been right. This is kind of interesting. Google. Google is one of the major players in outsourced cloud services. Sometimes we call this infrastructure as a service. And Google announced that it's firing 100 or so people in its cloud group. Why would it do it? Because the cloud group is supposed to benefit from their customers' voracious appetite for AI infrastructure. Kind of a mixed message. Very interesting. And the other thing that I've poo-pooed Google on, even though I own the stock long-term, owned it for many, many years, is they make these AI announcements, they get on the stage, microphones and lights, and they do these AI demos. And do you think that the AI demo would have been rehearsed a couple times? Because they've had some horrible screw-ups in front of the public. It's kind of a PR fiasco. They're kind of like, oh, they should be players in AI. but whenever they show us something, they screw it up. The latest is their overviews. If you go into AI search, you will see overviews instead of the regular search link data feedback. And these overviews kind of suck. They're showing the wrong information. And anyway, I believe that Google will be a leader in the space, right? They have all the pieces of the puzzle. And the big one is they have the dollars, the resources to fund this. But it is just one kind of PR fiasco after another. I think it's a communications problem. I don't think it's a long-term fundamental problem. But either way, it's damn embarrassing. And last, here's a company I haven't talked about before, ST Micro. It's a European semiconductor company, ticker STM. They're probably best known for industrial chips, maybe chips that go into your car, analog chips, microcontrollers. Anyway, they're not a major league player. They're a single A to double A ball club. And, the major companies are the New York Yankees and the MLB. But they are building, like everybody else, this AI infrastructure arms race, a pretty big fab in Italy. And Italy is not typically a place where one would build a fab. Very interesting. So anyway, let's get to my tech picks next. So here are my tech picks, and CrowdStrike is actually announcing their earnings tonight. I got them on yellow hold because I want to see the results. This is the best company in cybersecurity software. However, it seems like all of their competitors have already announced their quarters and they've given us downer news. So I got to believe it when I see it, even though I really admire CrowdStrike. I will come back on the next show and give you a thumbs up or thumbs down based on what I hear tonight about the quarter just reported and their guidance. Here are my other fresh money names, all in green. They haven't changed much. Micron, my favorite pick. And this is another interesting thing that recently there has been a big semiconductor conference with all the major players in Taipei, Taiwan. It's called Computex. And they've all announced NVIDIA, AMD, Intel, Qualcomm, ARM Holdings have all announced AI follow-on chips. Of course, they have to. They're very aggressively competing against each other. But the interesting thing is all these AI accelerator chips have a real voracious demand. They're hungry for memory. And Micron, SK Hynix, which is South Korean, and Samsung, which is also South Korean, dominate this HBM, high bandwidth memory, which is needed to build out the AI infrastructure. That is why Micron is my favorite pick, not NVIDIA, even though I own both. You can see my other list here, but one of the stocks I want to take a deep dive in right now is about halfway down that list, Dell. Now, Dell announced last Thursday, May 30th, so we're only 3 trading days in to their post-quarter announcement. And this stock got treated harshly by the markets after it reported its news. The stock didn't go down a dip. It went down a full bear market, 23%. Now, whenever I see a earnings surprise from one of my companies, I believe in the cockroach theory that if you have one poor quarter, it usually leads to many poor quarters. Just like if you see one roach, there's more. In this case, I took a deep dive into this company and I'm sticking with it. And I might even be prepared to buy some more. Here's what I think. So even though the company's overall numbers were just fine, a portion of their business, like everybody else that they're touting, is their growth in AI servers. And it exploded. And their order book for AI services shows it's going to accelerate even faster. But here's the deal. a number of the Wall Street analysts think that Dell is selling AI servers at cost. I know it's a very low margin product. However, I think that they're going to build those margins over time. Right now, it looks like they have only 5% operating margin in critical AI servers. I think that that goes up over time with scale and efficiencies. Take a look at how much Supermicro SMCI makes in AI servers, because that's essentially an AI server pure play. So we have that. And then the other thing about Dell that's interesting, it's pretty diversified. They sell traditional PCs, which will have an AI kicker in the second half of 24. They sell traditional servers. They sell, of course, AI servers. They have services that they sell to enterprises. Remember, Dell is a little bit distinct because it's more a enterprise hardware company than a consumer hardware company. And then they also sell storage. Storage goes with the hardware. So I think what happens is they will indeed boost their margins in AI servers, but the rest of its business will get pulled along, and those other businesses are higher margin. So I think they're going to be just fine. Now, this company has always met its guidance, and its long-term business plan is to grow its sales each year by about 4%, to grow its earnings per share each year by about 8%, that it's going to drop 100% of its adjusted net income to free cash flow, which is perfect conversion ratio. And then with all the gobs of free cash flow, which is what I call FU money or surplus cash, they're 80% of that they're going to give back to shareholders. And they will easily pay an annual dividend for the next several years that increases probably somewhere to 10 to 15% per year. So even if you want a tech or AI kicker, but you're a dividend investor, you don't get that kind of dividend growth from even the traditional dividend paying stocks. The other thing I think is interesting technically, when I mean technically, I'm talking about price charts. Take a look at this chart right here from stockcharts.com. This is a chart that extends over the last year. You can see that the blue line, which is Dell's 50-day moving average, has always been, when the stock takes a dip, a nice support area from which you can add to your position. So we're only 3 days after this report, which frankly was nasty compared to what the analysts were thinking. It looks to me like we are going to continue to hold the critical 50-day moving average, which is about $130 per share. And if we can do that, and it looks like a real strong floor, that is a very nice place in which to add to your Dell position. So I'm not going to sell any Dell shares on this disappointment. I'm going to probably buy some more at this 50-day moving average $130 per share floor. I think that the company's revenue growth will pick up. I think that they will boost over time their AI server margins, nice pull through in their other businesses when they sell AI servers to an enterprise. And the company's very well managed. I like Supermicro too. That's in the Meeks portfolio, SMCI. The obvious company in the space that I don't own, I don't like, is Hewlett-Packard Enterprises. That's probably Dell's closest competitor, ticker symbol HPE. The problem there is that stock is at a recent pop. I think it's getting to be a little bit expensive. Dell has a better revenue growth profile over time and probably higher margins too. So you guys, usually I believe in the cockroach theory. You give me one negative quarterly surprise, I am out. In this case, did a deep dive. I've taken a look at a revised free cash flow valuation. I valued the stock somewhere, I know it's a pretty wide range, between $145 a share and $195 a share. Even if you believe it only tops out at 145, which I don't, I think it's going much higher over time, then you have a little bit of a move from here, 135 to 145 on a short-term trade at least. So what I'll try to do is, when we have these sessions with Benzinga, I might take a deeper dive into a stock And that is what you need to know about my bullish, which is kind of a contrarian opinion right now on Wall Street for Dell. So let's move on and delve into some of the key tech trends. Keep watching interest rates. Remember, my rule is tech and aggressive growth stocks. 80% of the call is interest rates. 20% of the call is fundamentals. So I watched the CME Fed Watch tool. Right now, the 10-year Treasury note, which most people consider America's a risk-free rate, that security is yielding 4.36%. Yield has come down, which is good since our last session. We have a pretty important tell this Friday. This Friday will be the release of U.S. non-farm payrolls. And we're interested in, yes, we love to have all of our buddies get hired and keep their jobs. We'd like to see America's unemployment rate stay low. Right now it's at a historic low, but we just don't want any sort of indications of tightness in the labor market or further tightness in the labor market, because wage inflation will lead to overall inflation. And if we have overall inflation, our central bank, the Federal Reserve, can't do what we demand them to do, which is lower interest rates. In fact, I don't think they're going to lower interest rates this year at all. I think that's going to be pushed on to 2025. And I'm a little bit worried that if everybody comes to the same conclusion, you could see some hell to pay, at least in the short term, at the end of 24 in some of my tech and aggressive growth names. So stay tuned. I'll report back next week, but this economic data released Friday morning before the open, pretty damn important. The next thing I want you to take a look at is the US dollar. A lot of folks do not realize this, but we actually root for a weaker US dollar vis-a-vis other countries' currencies in which we trade. I know that sounds like you're being unpatriotic. You want a weaker US dollar, but how does it benefit US exporters in this way? Because if you manufacture something in the States, but you sell it in euros in the Eurozone, you'd like to have a weaker US dollar, so your products are cheap enough abroad, so they're sold. Also, when US companies make sales abroad and ultimately they repatriate them back to the United States and convert those euro sales into US dollar sales that show up on the company's income statement, then you're also rooting for a lower US dollar. Take a look at this chart. This goes back a ways. Take a look at the strength of the US dollar here when it's rising vis-a-vis a basket of other currencies. Even though we've come back a little bit in the last couple of years, that is a 10-year trend of where the US dollar appreciated all in by about a third. This is very significant, particularly for tech companies that do a lot of business abroad. Your favorite tech company might be headquartered in Silicon Valley, California, but it quite often does the majority of its business abroad. So we must stay on top of the US dollar. It has been very strong for a long time. And as long as US interest rates are high, the dollar will continue to strengthen. When US interest rates start to drop, remember, I don't think it's 24, I think it's 25, then we can see some relief. And yes, a weaker US dollar could be beneficial, at least to our tech exporters. The last trend I want to talk about today is Computex. Computex is the big electronics show in Taipei, Taiwan. It's been going on. And of course, every time one of these US semiconductor company CEOs goes up to the podium, he or she is talking about their greatness in AI. This is very interesting to me. Jensen Huang, who is the well-respected, no surprise, got over a $2 trillion market cap CEO of NVIDIA, talked about NVIDIA's product roadmap, not just for 25, 26, but into 27. And his commitment, which some people thought was aggressive, but now I think they're believing it, is to have a nice jump up in technology on a 1-year cadence. That's actually very fast turnaround for a tech company to be able to come out with a new product platform each and every year. People were skeptical before his speech at Computex. Now they're feeling better about it. AMD also made an announcement trying to chase NVIDIA as the second fiddle to NVIDIA's first chair. And then we had Intel. Intel made some announcements. I believe AMD will close the gap with NVIDIA, or at least semi-close the gap over time. AMD is a very well-managed company under their CEO, Dr. Lisa Su. However, Intel has been bullshitting us for years. They've had poor manufacturing for years. And so when their CEO, Pat Gelsinger, who I think is fine, he's doing all the things strategically that he needs to do with the company, but they're so far behind in manufacturing. When they make these claims, I don't believe them, because I've lost my respect over time for Intel. And yes, maybe I'll get back on board someday, but I will believe it when I see it. So anyway, coming out of Computex, really important, probably bolstering the investment case for both NVIDIA, even though the stock has already done so well, and Advanced Micro Devices, AMD. So that's what I have for you this week. We have some important things happening the rest of the week. I will report on them next Tuesday on our regular schedule. But till then, thank you very much. We'll see you next time.